but will also be within a secular bull market cyclical. I remember very well, Michelle, the decade of the 1970s when the gold price went from $35 an ounce to a high of $850 an ounce, a 30-fold bull market. In the middle of that amazing move, 1975, the gold price fell by half. The quote slipped from about $200, pardon me, to about $100. A whole bunch of people who had been gold faithful at 200 lost the faith at 100. They got shaken out just in time to miss a move from 100 to 850. The point of all this is that for reasons we'll discuss later, I think the gold price is going higher, but it will not be a smooth ride higher. They never are.
In the realm of precious metals, an extraordinary event is taking place. The laws of global finance could be rewritten by a silent battle between real silver and paper silver. In the past few months, gold has reached new highs as central banks and investors compete to protect against a weakening dollar. However, beneath the surface, silver's narrative is even more enigmatic. Rick Rule, an experienced investor, asserts that the silver market has become one of the most perilously leveraged systems in the world. A market in which 200 paper ounces are traded for every physical ounce that is genuinely available for delivery. That is not identical to 200%. This represents a leverage ratio of 200 to 1. He cautions that this imbalance is not sustainable. The entire structure could collapse if investors ultimately demand the delivery of actual metal instead of cash settlements. And as we have recently observed, those warning signals are already flashing, from global silver shortages to Indian ETFs halting new share creations. So, what occurs when the illusion of paper intersects with physical reality? That is precisely what we will analyze today. Let us return to the interview with Rick Rule and discover how this 200-fold leverage could serve as the catalyst for silver's most significant move to date.
That kind of choppy. When people tell me, oh my God, the quote's off 5% or 6%, I have to say, compared to what? The market in the course of 2 years is up 100%. Give me 100 and take away 6. I
Sure.
can live with that at any point in time. I believe, for reasons that I hope we discuss later in the interview, that gold prices go over the course of a decade much higher from here, not merely higher from here. But people who hope to play that game, if that's what it is, need to understand that the market will be, first of all, volatile, but will also be within a secular bull market cyclical. I remember very well, Michelle, the decade of the 1970s when the gold price went from $35 an ounce to a high of $850 an ounce, a 30-fold bull market. In the middle of that amazing move, 1975, the gold price fell by half. The quote slipped from about $200, pardon me, to about $100. A whole bunch of people who had been gold faithful at 200 lost the faith at 100. They got shaken out just in time to miss a move from 100 to 850. The point of all this is that for reasons we'll discuss later, I think the gold price is going higher, but it will not be a smooth ride higher. They never are. And you made a great point. The gold price is really all about real interest rates, I think. By real interest rates, I mean the difference between the yield on the US 10-year Treasury, the world's benchmark saving instrument, and the deterioration in the purchasing power of the US dollar. I want to begin, and I think you agree with me on this, Michelle. I've listened to your work, that the CPI is not an accurate measure of the deterioration of the purchasing power of the US dollar.
Mhm.
Anybody who buys stuff can look at the price of consumer goods in the period, say 2020 to 2025, and they know that we aren't suffering from 2.5% inflation. As you point out, it was Paul Volcker allowing interest rates to go up to 18 or 19% that broke the back of the gold rally because it made other savings and investment products more attractive than gold. I don't see that in the near term. So now, after that soliloquy, let me answer your question. Polite thing to do. Um, I believe that very similarly to the decade of the 70s, the US dollar will, in the next 10 years, lose 75% of its absolute purchasing power. I believe we'll do that because of on balance sheet and off balance sheet deficits in the US government, relative both to gross government income, but also relative to the size of the GDP. I don't think that we have the political will to have a default in terms of off balance sheet obligations. So I think we'll have a stealth default, a default where we inflate away the net present value of the obligations. I believe further, Michelle, that the decline in the real purchasing power of the U.S. dollar, the absolute decline in the purchasing power of the U.S. dollar, will generate a nominal, which is to say, U.S. dollar gold quote that mirrors the decline in purchasing power. So a 10-year long threefold increase in the gold price, or even a full fourfold increase in the gold price, is something that a reasonable statistician could imagine with a 75% decline in the purchasing power of the US dollar.
Rick Rule has dedicated decades to the study of commodity markets, and his message is now unmistakable. The pricing system of silver is based on leverage rather than supply and demand. The volume of silver futures on COMEX and the London bullion market can exceed the quantity of deliverable silver by as much as 200 times on each trading day. This implies that hundreds of contracts are vying for the same restricted metal supply, and the majority of them are never resolved in physical form. They continue to advance month after month, eliciting the appearance of liquidity while concealing profound structural fragility. This system is only functional if no one challenges the bluff, as per the rule. However, when physical premiums are present, such as a 4% increase in the price of silver in London compared to Chicago, traders are eager to accept delivery and capitalize on the arbitrage. Each time this occurs, the paper-to-metal ratio tightens, and tension accumulates across the exchanges as metal exits the vaults. This tension has already been observed in 2025. The price of silver rose above $50 per ounce due to a decrease in inventories, an increase in lease rates, and the inability of global mints to satisfy retail demand. New unit creation was even suspended by certain Indian and European ETF providers due to their inability to obtain an adequate quantity of physical silver. In the interim, gold reached record highs exceeding $4,000, indicating a more extensive shift away from fiat currencies. However, silver, the lesser market, experienced significantly more volatility. Rule elucidates that silver could experience a 600% increase if gold experiences a 300% increase during this bull run, a scenario he considers plausible in light of central bank purchasing and de-dollarization. He does not rely on speculation. Rather, he has observed each precious metal bull market. Eventually, silver separates from gold, experiences a roughly doubled rate of return, and attracts late-cycle investors seeking greater returns. However, he also cautions investors to avoid conflating short-term manipulation with long-term suppression. The near term is the focus of all markets, from LIBOR to treasuries. Silver's distinction is proportion. Concentrated trades can momentarily affect prices due to the abundance of paper claims on a limited amount of metal. However, price suppression collapses violently when physical demand surpasses paper control. This is the reason why the rule mandates that genuine investors must possess physical metal, rather than ETFs or futures, in order to capitalize on the eventual reset. As a result of the cash settlement system's failure, the exchanges will safeguard their members, rather than you. He does not believe that the impending situation is the result of a trader-engineered siege. It is a natural revaluation of the true monetary and industrial value of silver, which is accelerated by the global distrust in the Western financial order.
The US dollar versus itself, rather than the Canadian dollar, the Swiss franc, or the euros. I think that the US will hold its own against other currencies in relative purchasing power. My friend Doug Casey says the US dollar is the worst currency in the world, with the sole exception of all of the others. And so, well, diversifying out of the dollar into other currencies, I don't think gives people the absolute protection or even the relative protection that maintaining savings in gold would generate. And I absolutely concur with your previous remark, which is to say, since the establishment of the Federal Reserve, the US dollar has lost 97% of its purchasing power. That means there's 3 to go, a little bit at a time. We had a dramatic downshift in the purchasing power of the US dollar in the period 1970 to 1980, a recovery, a percentage recovery, at least in the early part of the decade of the 1980s. And I think that we're headed back into a period where the downward trajectory in the real purchasing power of the US dollar gains momentum. There's something in Social Security. You're going to give me that
I
4,000.
think you have other sources of income, thankfully, but yes, but from Social Security, yes, okay.
The point of all that is that I'll still get my $4,000 or whatever it is that they give me, but it'll buy what is today $1,000 worth of goods and services.
Hmm.
That's what'll happen, and it's not going to be a pleasant place for old codgers like me who don't have other sources of income. For me, it's a subject of amusement or something that I utilize to make a point. There are millions of Americans on fixed income who don't have the ability and haven't planned well enough to augment that income that are going to have an ugly time in the next 10 years. And that ugly time that they have, I think, will have both political and social manifestations. I'm not one who is able to comment on those. I'm only one who is able to comment on how one might diversify one's savings to
Yeah.
minimize the bad outcomes.
Right, but yes, to your gold backed, not
Well, those are
necessarily.
very, very, very different things. Gold denominated and gold backed are very, very different. A gold backed currency means that you can surrender it and you can receive gold for that. That
Right,
in and of its nature requires prudent governance.
sure.
A government that spends within its means and can service its debt. Being a politician in such a circumstance is no fun whatsoever. Can you imagine, as an example, our president being constrained in his big, beautiful budget by how much gold he had in the treasury that he could distribute to U.S. savers? Could you imagine President Xi doing the same thing? Uh, People are politicians because they want to exercise power. Gold constrains the politician's power, which is the reason that the people like it. The idea that the politicians would willingly give up the thing that they strive for in life most, which is power, is inconceivable to me. Now, I do believe that individuals can and should have their own gold reserve. I personally save in gold. I maintain liquidity in US dollars. Those are very, very different words. And if you have saved in gold systematically, as I have for 25 years, and you look at the prices of goods and services in 25 years, you are struck by how cheap things are. If by contrast, for that portion of your account that you maintain in dollars, you're struck by how expensive things are. So while at the same time, I don't believe that I will in my lifetime or you in your lifetime see gold function as a real reserve currency, which is to say a direct currency, I do believe that individuals can and should structure their own life in a way where, at least with regards to their savings, they monetize their host fiat currency into gold.
Right. Rick, I don't believe that the suggestion is that we'll have a gold-backed currency redeemable for against gold, and certainly not on an individual level. I mean, even when we had the Bretton Woods Agreement, it wasn't that individuals could come and exchange their dollars for gold. It was other countries. I believe that the thesis amongst many in the gold community is that we will have gold return to the monetary system as a neutral reserve asset, which will restore some kind of faith in the countries that choose to have it as an underlying link.
I think the Nixon presidency is the best thing to consider historically with regards to that, which is to say that some countries will likely have a gold link, particularly the BRICS countries, for as long as they can. You'll remember that the United States, not for its own citizens, who were obviously second class, but rather for the world, had convertibility of US dollars to gold until it was inconvenient. At which point in time, President Nixon said, too bad, so sad, big lie, strong letter to follow. My suspicion is that the BRICS proposal, where they enter into bilateral transactions, either in a BRIC central currency or in their individual currency, and there is convertibility in China, conveniently, from those currencies into gold, will last until it doesn't. And then I suspect that Putin's nickname will be Nixon, and Lula's nickname will be Nixon, and whoever the guy is now that runs Iran, his nickname will be Nixon. In other words, they will have convertibility from their fiat trash into gold for as long as they can honor it, and after that, they'll repudiate it.
Rick Rule's concluding message to investors in gold and silver is straightforward. Concentrate on the fundamentals rather than the headlines. Abstain from exploiting daily fluctuations. Comprehend the framework situated beneath them. Silver's leverage of 200 times is not a trading statistic. It is a time hazard. Upon its detonation, the process of price discovery will transition from speculation to scarcity, from the West to the East, and from paper to physical. Therefore, the inquiry is as follows. Are you adequately equipped to manage that transition? Are you storing genuine assets, or are they merely displayed on a screen? Please share your thoughts in the comments section. Is it possible for silver to surpass gold in this cycle? Or will the bullion institutions maintain their control for an additional period? If you found Rick Rule's insights to be valuable, please consider liking this video, subscribing, and activating notifications. At Macro Edge, we strive to uncover the genuine forces that influence the global economy, gold and silver, by transcending the cacophony. Be alert, remain informed, and remember that the medal is always the winner when the paper competitions conclude.